So, what does it really take to pass the ultimate investment test? You know, the one designed by Warren Buffett himself? Well, today we're going to put one company, Jack Henry and Associates, through that very gauntlet. We're going to see if it truly has what it takes to be called a Buffett-style stock. All right, just imagine for a second the perfect investment. I'm talking about a company with a bulletproof business, brilliant management, and financials that are just flawless. You know, the kind of stock that lets you sleep like a baby at night. Well, what if I told you we might have found one that seems to tick every single one of those boxes? That company is Jack Henry and Associates. And yeah, on paper, it looks like a textbook A-plus Buffett-style investment. But, as we're about to find out, there's a huge difference between a wonderful company and a wonderful investment. And that difference, it's everything. Okay, so let's dive right in with Buffett's first and honestly his most important pillar, the business itself. Does it have what he calls a durable competitive advantage, an economic moat? For Jack Henry, the answer is a big, resounding yes. Now, if you're new to this term, an economic moat is exactly what it sounds like. It's this protective barrier that keeps all the competitors at bay, just like a real moat protects the castle from invaders. But in the business world, we're not talking about water and walls, of course. We're talking about a powerful advantage that makes it incredibly difficult, or just ridiculously expensive, for a customer to even think about switching to a rival. So, how does this moat actually work for Jack Henry? Well, it's all about creating this powerful lock-in effect. See, they provide the core software that runs small and mid-sized banks. Think of it as the digital heart of the entire operation. Tearing it out and replacing it isn't like changing your email provider. Oh no. It's more like performing open heart surgery, a multi-million-dollar, multi-year nightmare. And the result? Customers pretty much never leave. This creates these massive switching costs and gives Jack Henry this incredibly steady, predictable stream of revenue. Now that is a powerful business model. A great business is one thing, but you need a great captain steering the ship, right? That brings us right to Buffett's second pillar. You need a management team that is not only honest, but is also super rational in how it uses the company's money. And believe me, Jack Henry's leadership team absolutely shines here. It's not just about their reputation, it's about what they do. They've been paying out dividends for more than 2 decades, and they're constantly buying back their own stock. But here's what's so crucial. They avoid those big, ego-driven, risky mega mergers that can totally destroy a company. Instead, they just stick to their niche and they dominate it. That, my friends, is true discipline. All right, so you've got a great moat, you've got great management. That should lead to some amazing financial results. And with Jack Henry, the numbers, well, they speak for themselves. They're frankly stunning. First up, let's talk about return on equity, or ROE. Think of this as a report card for how well management uses shareholders' money to make even more money. Buffett usually considers 15% to be good. Well, Jack Henry's 5-year average is over 21%. That's not just good, that's the mark of a truly elite cash-generating machine. Okay, next, just look at this. A debt-to-equity ratio of 0.01. Let me put that in simple terms. This company has basically zero debt. It funds all of its growth from its own profits, which is incredibly rare and shows just how financially conservative they are. This is a fortress balance sheet. And finally, we have the operating margin. This number shows you how much profit the company squeezes out of each dollar of sales. An average of nearly 25% over 5 years is just fantastic. It's proof that their moat gives them real pricing power. They can raise prices without scaring off customers. So let's recap. We have a near-perfect company, a wide moat, fantastic management, spectacular financials. It passes the first 3 tests with flying colors. It all sounds perfect, right? A dream stock. Well, not so fast. Here comes the final and often the most difficult hurdle. It's summed up perfectly by Buffett's famous quote, "Price is what you pay, value is what you get." And this is where things get a little tricky. See, to figure out what a company is truly worth, analysts use a model called a discounted cash flow, or DCF. The source analysis actually ran 2 different versions of it. A conservative one, which came up with a fair value of about $167, and then a more optimistic one, valuing it at $232. With the stock currently trading right around $165, we're staring at a dilemma. Is it a perfectly priced gem, or is there just no bargain to be had here? And that really brings us to the heart of the matter. The market isn't stupid. It knows Jack Henry is a wonderful company. This is no hidden secret, and its quality is already baked right into the stock price. We found a masterpiece, all right, but it doesn't seem to be on sale in the bargain bin. Which brings us to the final verdict from the analysis. a hold. So, what exactly does that mean? Well, if you already own shares, it's a keeper, for sure. But if you're a new investor looking to get in, it's not a clear buy right now. And that's because there's no margin of safety, that little discount between the market price and its true value that protects you if things go wrong. And this right here is probably the biggest takeaway from our entire analysis today. The discipline of value investing isn't just about finding quality companies. It's about having the patience to wait for that quality to go on sale. The analysis suggests the smartest move is to put this fantastic company on your watch list and then wait. Wait patiently for a market panic or some temporary bad news to give you that opportunity to buy it at a truly great price. So I'll leave you with this question to chew on. For a business with a moat this wide, management this sharp, and financials this strong, how much of a discount do you really need? When the quality is this high, what price are you willing to pay?